Hello, friends. Welcome to a new episode of BookBox. In today's episode, we will be reviewing highly influential book in the field of economics and finance, Irrational Exuberance by Nobel laureate Robert James Shiller. This book explores why financial markets often behave irrationally, how bubbles are formed, and why human psychology plays a crucial role in economic booms and crashes. This book first published just before the burst of the dot-com bubble in 2000. The book explores how psychological, cultural, and structural factors, rather than pure fundamentals, contribute to asset price inflation, particularly in the stock market, real estate, and bond markets. Schiller's core argument is that markets are not always rational or efficient, and periods of intense market enthusiasm often lead to bubbles. Unsustainable increases in asset prices fueled by investor behavior, media influence, and collective psychology. His insights were prophetic, predicted both the collapse of the technology bubbles and the later real estate crash leading to the 2008 financial crisis. Before we proceed, let's know about the author of this book. His full name is Robert James Shiller. He is a renowned American economist, best known for his work on behavioral economics, financial markets, real estate economics, and asset price volatility. He is currently a Sterling Professor of Economics at Yale University, where he has taught for decades. Scheller is also affiliated with Yale School of Management, National Bureau of Economic Research, Cowles Foundation for Research in Economics. He has been an influential voice in both academic and public discourse, often warning against speculative bubbles and the psychological forces driving market behavior. Major contributions and achievements. Scheller was awarded the Nobel Prize alongside Egon Fama and Lars Peter Hansen for their empirical analysis of asset prices. While Fama emphasized market efficiency, Scheller challenged this notation by showing how irregular behavior often drives volatility in financial markets. Scheller is a leading figure in behavioral finance, blending psychology with economic theory to understand market anomalies, bubbles, and crashes. With economist John Campbell, Scheller developed the cap ratio, a widely used metric to evaluate stock market valuation over the long term. It adjusts the PE ratio based on 10 years inflation adjusted earnings. Scheller famously predicted the dot-com bubbles in 1990s, the United States housing bubbles in mid 2000s. He warned of these bubbles in real time and documented them in books like Irrational Exuberance. His other notable books are Animal Spirits, published in 2009 with George A. Akroloff, which explores the role of human psychology in economics. Then he published Finance and the Good Society defends the social values of finance when properly regulated. Then in 2019, he published Narrative Economics, which introduces a novel idea that economic behavior is influenced by the power of viral stories and narratives. Now we discuss what is the purpose of this book. Irrational exuberance is an inflational economic treatise that investigates the psychological, structural, and cultural forces behind financial market bubbles. Scheller challenges the notion that markets are inherently rational and efficient, arguing instead that human behavior, emotion, and media driven narratives can cause asset prices to diverge dramatically from their fundamental values. Core arguments. Shiller contends that speculative bubbles, particularly in stock and real estate markets, are fueled by irrational investor behavior, herd mentality, and feedback loops. These factors lead to unsustainable booms followed by sharp corrections or crashes. His work is a direct critique of the efficient market hypothesis, the EMH, offering a behavioral lens to understand market volatility. Key concepts and themes. The first concept of this book is behavioral economics and market psychology, which deals with investors' overconfidence, herd behavior, and emotional decision making distort market outcomes. Psychological factors like euphoria, fear, and regret play a significant role in financial decisions. Cultural and structural amplifiers. Widespread media coverage, technological innovations, and easy access to investment tools spread speculative narratives. Changes in monetary policy, low interest rates, and global capital flows contribute to asset price inflation. Historical evidence and empirical data. Scheller uses long term data on stock market performance, real estate prices, and beyond yields to demonstrate patterns of overvaluation. He introduces cyclically adjusted price to earnings or cap ratio to assess long term stock market valuation. Housing and bond markets. Later, he introduced housing and bond markets. The 2005 edition extends the analysis to the United States housing markets, warning of a bubble that eventually burst in 2007 and 8. The 2015 edition included bond markets, exploring the impact of persistently low interest rates. Policy and societal implications. Scheller argues for increased public financial literacy, stronger regulatory oversights, and institutional reforms to minimize the damage of financial bubbles. He warns that unchecked speculation can destabilize economies and erode public trust in financial systems. So he anticipated both the dot-com crash and the United States housing market collapse. He has helped establish behavioral finance as a vital field in economics. So we can say that rational exhibition is a foundational text that redefines how we understand financial markets by exposing the psychological undercurrents of economic behavior and highlighting the dangers of speculative euphoria. Scheller provides a powerful warning against blind faith in market rationality. The book remains essential reading for economists, investors, policymakers, and anyone seeking to grasp the true diverse of market volatility. This book is divided into six parts. Each part has some chapters. Let's know about them. The first part is structural factors influencing market volatility. In this part of this book, the first chapter is the stock market in historical perspective. In this chapter, Scheller presents long term historical data on stock prices, earnings, and dividends, showing that recent market valuation, especially in the late 90s and 2000s, are enormously high. He introduces the CAPE ratio as cyclically adjusted price earning ratio to argue that stocks are overvalued. Then in chapter 2, precipitating factors, the internet, the baby boom, and more. This chapter examines the forces that sparked investors' enthusiasm and bubble formation, such as the technology boom, the rise of the internet, demographic shifts, for example, baby boomers entering peak saving investing years, and globalization. These contributed to an environment conducive to speculative investment. Then in chapter 3, amplification mechanism, naturally occurring Ponzi processes. Taylor explains how feedback loops operate in financial markets. Like rising prices attract media attention, more investors enter the market, especially immatures. Further price increases occur, reinforcing the bubble. He likens this process to a natural Ponzi scheme where early entrants benefits at the cost of latecomers. Then in second part, the cultural and psychological factors. In chapter 4, the new media, the role of the media in spreading economic narrative is central. Media reports often amplify excitement or panic and fuel herd behavior. Scheller emphasizes how sensational news shapes investor sentiments and behavior more than fundamentals. And then in chapter 5, New Era Economic Thinking, this chapter explores how bubble era is accompanied by the belief that this time is different. Scheller receives a historical new era, thinking and arguing that such optimism is really justified. During bubbles, investors often ignore warning signs under the illusions of a fundamentally transformed economy. The new eras and bubbles around the world. Scheller looks at speculative bubbles in international context. For example, Japan's stock market in the 80s and emerging markets, etc. Showing that these dynamics are not unique to the United States. He argues that irrational exuberance is a global phenomenon. And in chapter 7, the psychological anchors for the market. Scheller draws on behavioral economics to explain why investors overreact or underreact, anchoring respectativeness, heuristics, availability bias. These mental shortcuts distort rational decision making and influence asset pricings. In chapter 8, herd behavior and epidemics, market often behave like crowds, where individuals follow others rather than making independent decisions. Scheller compares market bubbles to epidemics. Ideas and enthusiasm spread virally, infecting the minds of investors in mass. Then we come into third part, the speculative bubbles. In this part, we discuss chapter 9, the efficient markets, random walks, and bubbles. This chapter critiques the efficient market hypothesis, the EMH, showing that prices do not always reflect fundamental values. Scheller argues that market volatility is too high to be justified by changes in dividends or interest rates alone, supporting the existence of bubbles. Chapter 10, Investors Learning and Unlearning. Scheller discusses how investors' education often fails to correct biases. In fact, learning can be selective or misdirected during bubbles. Many investors unlearn cautions and become overconfident during speculative booms. Chapter 11, Speculative Volatility in a Free Society. This chapter reflects on the philosophical and ethical implications of speculative bubbles. Scheller argues that a free market society must address these tendencies through education, policy, and regulation to reduce long term economic harm. Then, in fourth part, the real estate market, chapter 12, the recent boom and bust in historical perspective. Scheller tracks the dramatic rise and fall of United States home prices, particularly in 1997 to 2006. He shows that housing prices had historically been stable and that the recent volatility is unprecedented and indicative of a bubble. Chapter 13, a bizarre pattern. This chapter explores the strange and unsustainable assumptions that fueled the housing bubble. Beliefs that home prices could never fall, easy mortgage credit, speculative flipping, and blind faith in rising returns. Chapter 14, The Construction of Real Estate Market Bubbles. Scheller explains how the housing bubble formed via similar mechanism to the stock market bubble. Feedback loops, media hype, cheap credit, and collective irrational behavior. He emphasizes the dangers of financial innovation without adequate oversight. Then we come to part 5, the bond market in historical perspective. In this part, he discussed chapter 15, an excursion into bonds, added in the 2015 edition. This chapter analyzes the historically low interest rates following the 2008 crisis. Scheller expresses concern that bond markets may also be experiencing a form of exuberance with yields not reflecting underlying risks. Then finally in chapter 6, public policy and the future. In this part, chapter 16, speculative volatility and economic welfare. Scheller discusses how market volatility can harm the broader economy by misallocating resources and creating instability. He warns against over reliance on market mechanisms to guide long term economic decisions. Chapter 17, Policy Measures to Mitigate Bubbles. This is the final chapter. This suggests solutions to reduce bubbles risks, including improved financial literacy, better regulation and transparency, the development of new financial instruments, for example, micro markets, and more responsible media coverage. Scheller emphasizes that policymakers must acknowledge behavioral factors in shaping financial regulations. So, in Irrational Exuberance, Scheller offers a detailed interdisciplinary analysis of how financial bubbles form and why markets often behave irrationally. Through historical data, behavioral insights, and policy recommendations, the book explains how enthusiasm turns to mania and eventually collapses, causing significant damage to investors and the economy. Each chapter builds a compelling case for why we must rethink the nature of markets and develop tools to prevent future crises. This book is very relevant in academia. In this, Sheller's work reshaped how economists think about market dynamics and investors' behavior, contributing significantly to the field of behavioral economics. And in case of policy impact, his warning influenced regulators, central banks, and the broader policy debts on financial stability. And for public appeal, it unlikes most technical economics literature. The book is written in accessible language, making complex ideas understandable for general readers. As far as the strengths of this book is concerned, it is timely and that is accurately predicted both the dot-com and housing bubbles. Its interdisciplinary approach combines economics, psychology, sociology, and history. It is data driven, rich in charts, historical comparisons, and statistical evidences, and very important educational values. It clarifies the mechanisms of bubbles and investors' irrationality. So, Irrational Exuberance by Robert James Shiller is a powerful and enduring critique of the idea that financial markets are always rational and self correcting. Combining empirical evidence with insights from psychology and sociology, Scheller convincingly demonstrates that market booms and busts are deeply rooted in human behavior, collective emotions, and socially transmitted narratives. While the book does not provide precise tools for market timing or fully developed policy solutions, its greatest strength lies in reshaping how we understand financial instability. It teaches that Market success are not anomalies, but recurring features of economic life in a free society. Ultimately, Irrational Exuberance remains a seminal work that encourages economists, investors, and policymakers to move beyond blind faith in market efficiency and to recognize the critical role of human psychology in shaping economic outcomes. Its relevance continues in an age of rapid information flow, speculative manias, and global financial uncertainty, making it an essential contribution to modern economic thought. So, irrational exuberance stands as a defining work in modern economic thought, reminding us that financial markets are not pure systems governed by numbers alone, but human arenas shaped by emotions, belief, and collective behavior. Shiller's insights compel us to question complacent assumptions about market rationality and to approach economic decision making with humility, critical awareness, and responsibility. In an era of recurring bubbles, rapid narrative driven speculation, the book's central message remains clear and urgent. Understanding markets require understanding human nature. We recommend this book because it does not promise quick profit or simple answers. Instead, it offers wisdom. It equips readers with the intellectual tools to recognize market excess, question popular narratives, and make more informed, thoughtful economic judgments. Thank you very much.